You've built your business with decades of hard work, the late nights, the risks, the sacrifices, all of it leading to the day when you can finally sell, step back, and enjoy retirement. But here's the reality most business owners don't see coming. When you sell, the CRA could take 40 to 50% of your exit. That means if you sell your company for $3 million, you might only walk away with $1.5 million after tax. And that's not just numbers on paper. That's the difference between financial freedom and financial stress, between fully retiring and feeling like you still need to work. The good news, well, with the right planning, you don't have to let Ottawa become your biggest partner at the finish line. Hi, I'm Alex Kellerman, certified financial planner with IG Wealth Management. I help Canadian business owners prepare for one of the biggest financial events of their lives, selling their company and turning it into a retirement plan. If you'd like a personalized exit strategy designed to minimize taxes and maximize your wealth, click the link in the description to book a free call with me. Part 1, the tax traps business owners face. So when a business owner sells, here's what can happen. You have capital gains tax. Sell shares and 50% of the gain is taxable. On a $2 million gain, that could mean $400,000 to $500,000 in tax. 2, depreciation recapture. Sell assets instead of shares, and all the depreciation you claimed over the years gets added back as taxable income, often at the top rate. Number 3, double taxation. Without the right structure, you could be taxed once inside your corporation, and then again when you pull the money out personally. For most owners, their business is their retirement plan. And if the CRA takes half, there's not enough left to fund the lifestyle they've worked for. Part 2, why planning early matters. So the problem is most owners don't start exit planning soon enough. They wait until the deal is already on the table, and by then it's usually too late to restructure the company, qualify for exemptions, or set up advanced planning strategies. So the earlier you start, ideally 3 to 5 years before you sell, the more options you have to reduce taxes and protect your wealth. Part 3, smarter strategies to reduce the CRA's share. So how do you keep more of your hard-earned wealth? So here are the key strategies. 1, the big one, the Lifetime Capital Gains Exemption. This is the most powerful tool for Canadian business owners. In 2025, the Lifetime Capital Gains Exemption is over $1.25 million per person. If you and your spouse both own shares, that's over $2.5 million tax-free. But your company must qualify as a qualified small business corporation, which takes preparation. Miss the requirements and you could lose the exemption entirely. Number 2, sell shares, not assets. Share sales are usually much more tax efficient than asset sales. Asset sales trigger depreciation recapture and higher taxes, whereas share sales allow you to use the Lifetime Capital Gains Exemption and avoid double taxation. The buyer might prefer assets, but negotiating a share sale can make a huge difference in your after-tax outcome. 3, use a holding company for tax deferral. Instead of selling and paying personal tax right away, you may be able to sell shares into a holding company, and then you keep the proceeds inside the company tax deferred, and then you draw income gradually over time at lower rates. This creates flexibility and keeps more of your capital working for you. Number 4, estate freezes and family trusts. If your goal is succession, passing the business to the next generation, tools like estate freezes and trusts can lock in today's business value, pass future growth to your kids or a family trust, and reduce the capital gains hit at death. This strategy keeps the business in the family while reducing taxes. Number 5, charitable giving at the time of sale. If giving back is part of your vision, you can align philanthropy with tax efficiency. Donating publicly traded securities before the sale can eliminate capital gains tax. And then also donor-advised funds in private foundations can provide tax relief while building a lasting legacy. Part 4, common pitfalls to avoid. Now, business owners often get caught by these mistakes. Number 1, the big one, waiting until the deal is signed. By then, the big tax opportunities are gone. Number 2, not qualifying for the Lifetime Capital Gains Exemption. Something as simple as too much passive cash in the business can disqualify you. Number 3, selling assets instead of shares, and this often doubles your tax bill. And number 4, not thinking about succession. A lack of planning can reduce both the value of your business and the tax efficiency of your exit. Part 5, a real world example. So let's take Sarah. She's age 60, selling her consulting business for $2.5 million. Without planning, she sells assets, She doesn't qualify for the Lifetime Capital Gains Exemption, and she pays over $1.1 million in taxes. Now, with planning, she restructured early to qualify for the Lifetime Capital Gains Exemption. She and her spouse both used their exemptions, sheltering $2.5 million, and she sold shares, not assets, and used a holding company to defer personal taxes. So her personal tax bill dropped from $1.1 million to under $300,000. That's an $800,000 difference, all because of planning. Part 6, your next step. If you're a business owner approaching retirement, your exit isn't just another financial decision. It's the culmination of decades of hard work, and for most owners, it represents the single largest financial event of their lives. But here's the problem. Many owners spend years perfecting their product, serving clients, and growing revenue, but very little time preparing for the sale itself. They assume that once they find a buyer, everything else will fall into place. Unfortunately, that's when reality hits, and the CRA ends up collecting a massive share. Think about it this way. If you spent 30 years building a business worth $3 million, every 1% difference in tax efficiency is worth $30,000. Now that means even small improvements in planning can translate into tens or hundreds of thousands of dollars. But the difference between poor planning and smart planning is rarely 1%. It's often the difference between keeping 50% of your exit versus 80% and more. And that can mean, funding the retirement lifestyle you've envisioned rather than scaling it back, having the liquidity to help your children or grandchildren instead of watching much of it vanish in taxes, leaving behind a lasting legacy for your family and community instead of letting Ottawa take a bigger share than you ever intended. The reality is this: you only sell once. You do not get a do-over, which is why planning early, ideally 3 to 5 years before your exit, is absolutely essential. At the end of the day, selling your business is about more than cashing out. It's about turning decades of sacrifice into the freedom and security you've worked for. The CRA will always take its share, but it doesn't have to take half. With strategies like the Lifetime Capital Gain Exemption, structuring for a share sale, using a holding company, setting up estate freezes, and charitable giving, you can protect what you've built. But here's the key. The earlier you act, the more options you have. Wait until the last minute and most of these opportunities disappear. Start now and you can design an exit on your terms. So here's your next steps. If you'd like a personalized exit strategy, one that minimizes taxes and maximizes your retirement wealth, click the link in the description to book a free call with me. And if you found this helpful, give it a like and share it with another business owner who's thinking about retirement. Because after all the years you've invested in your business, you deserve to keep the full value of what you built, not hand it over to the CRA. Thanks.